the next slide here is our Cal Plus Zip program at 2% with our My Home Assistance combined with this program. So on this program, your client will have an FHA first mortgage. Our My Home Assistance is in a second lien position covering the down payment requirement. And you have the Zip in a third lien position covering a portion of the closing costs. So it's the same figures. You have the same purchase price, same loan amount on an FHA. My home is coming in at 3.5%, which is covering $21,000, meeting their down payment requirement. The ZIP is calculated at a 2% loan amount, which equates to $11,782. Now, I mentioned when you add our Cal Plus Zip program, the interest rate is slightly higher, and the interest rate is at 7.75%. But some clients have the income, they make the money and can afford this interest rate, but just don't have the means of having a savings account to come in with that down payment or closing costs. And this is how that program can serve those clients. Their monthly payment, principal PITIA, that's principal, interest, taxes, and insurance, is calculated at $5,261. I estimated the closing costs at 2%. I know that's very low, and that's coming in at $12,000. Essentially, on this program, because the ZIP loan amount is at $11,782, that ZIP loan amount would essentially absorb a lot of the closing costs that the client would need to bringing in their estimated contribution or the funds that they have to bring in to $218. And that's not even including a seller credit. So I just want to make sure because I know that this is a broker call. What's gonna set you apart from all the competition out there on offering our program is your service, your level of service that you provide to the client, and your array of options that you have because you have it all. You can submit to various lenders and offer them various products to help meet their needs. But on our Cal HFA program, it also goes down to how much you set to charge on this loan because this is a borrower compensation program where what you charge isn't built into the interest rate as a rebate. It's actually affecting their closing costs. So keep that in mind. But again, there's ways to absorb what you charge to help them get into the program. As I mentioned, you can combine grants to help with some of the closing costs, other community seconds. So there are ways to absorb the closing costs when you're building in your origination. But let's get to the requirements. I talked about the programs. I explained our My Home. I talked about our Cal Plus Zip. What are the requirements of the program? So we do ask that the borrower have a minimum credit score of 640 when you're offering the government programs. That's an FHA, VA, or USDA. We ask that their minimum credit score is at least 640. I know that if you're not using Cal HFA, you can go a lot lower. We are just at a standpoint to where they have to have that 640 credit score. Now, if you're offering a conventional loan using our first mortgage and you're following Fannie Mae Home Ready guidelines, we do not allow Freddie Mac. If you're on a conventional loan, the minimum credit score is 680. We will go down to a 660 credit score for anyone that's considered low income. And I'm going to explain that in a bit on the next slide. The max debt to income is a hard stop at 45% if their credit score is below 700. Now, if you have a client that has a 700 or above credit score, we will allow a 50% DTI, and that's a hard stop. So there's no exceptions to the debt to income ratio. So if your client is a hair over at 45.01, we do not offer exceptions on the debt to income requirement. But guys, there's ways to structure and make that file fit. If you're doing a conventional loan, we will allow single premiums or split premiums. And when I say that, that's where your client is buying out the MI. And it would take for you to get an MI quote from whatever lender that you're submitting this transaction to. But you can buy out the MI to reduce the debt to income, or you can have the client pay down debt to reduce the debt to income ratio. There's multiple ways that you can structure the loan to help them meet the program requirements. We even allow permanent rate buy downs, and that's where your client can buy down that interest rate to an affordable payment for them. And we'll talk about that a little later. But those are our debt to income requirements. On a Cal HFA program, we have our definition of a first time home buyer rule. And our definition is no ownership interest in your primary residence within the last 3 years. So keep this in mind. You might have individuals that own a property and it's an investment property and it's only one property. They could potentially still be considered a first-time home buyer. We would need additional documentation if there's a history of them owning a home. Acceptable documentation would be either a verification of rent from a qualified property management company, or I'm so sorry. My my printer this came on. So sorry about
You
that.
can't hear it. It's okay. Yeah.
Okay. We do have so for the first time home buyer requirement, if your client owns an investment property, one investment property, but they haven't lived in that investment property within the last 3 years, we would ask that you provide one of the three items, and that's either a verification of rent from a property management, proving where your client is living or renting from, separate from that investment property that they own, or they could provide cancel rent checks for 3 years, or a 3-year utility bill history showing where they've had utility service that's separate from the investment property that they own. So keep that in mind. But if you have a true first-time home buyer, there's no need to provide that additional documentation. This is only when your credit report has a history of your client owning a property within the last 3 years. So for those individuals or that co-sign for a mortgage, keep in mind, you have to ask that question. If you co-signed for a mortgage, have you lived in that property within the last 3 years? If the answer is no, okay, they may be considered a first-time home buyer, but they will have to provide additional documentation to show where they currently pay rent. And we're very specific on the particular documentation we will accept. Now, for when you're using our Cal HFA down payment assistance or closing cost assistance program, your client does have to complete the homebuyer education course. It is important that if you know that your client is going to use one of our programs, that they complete the course early in the process. I can't tell you how many times I get calls from folks that wait till the last minute. They wait till when the loan is about to close and they need docs immediately. You do not want to wait that long. You want to be proactive, right? When your client comes to you and you're collecting their income documentation, pull in their credit, and you've decided and you know that they fit the program guidelines well before they locate a property to purchase, you want to make sure that they know to complete the homebuyer education course early in the process. Please make sure that they're using the links on our website to register for the homebuyer education course. And make express the importance of completing this course to them because it will help them become a successful homeowner. It explains topics about how to budget. It explains what true home ownership is after the loan closes and you're well on working on your next transaction. So please make sure that they do that early in the process. After they complete the course, they will receive a certificate. This certificate is good for 1 year. And once they receive that certificate, they need to provide a copy of that certificate to you so that you can submit that in your compliance review file when the file is submitted to CalHFA. We only require one borrower on the loan to take the homebuyer education course. We have about 3 options available for your client to take the course. But guys, I can't stress it enough. Do not wait to the last minute to have your clients register and complete that homebuyer education course. And I also want to let you know that we do not accept certificates from frameworks, and I believe that's through Freddie Mac, and we do not accept the certificate from Fannie Mae HomeView. So if you want to avoid those issues, please make sure you're using the links on our website to have your client sign up for the course. Now at CalHFA, we have very, very moderate income levels because I believe CalHFA, we get it. We know that folks need to make money to afford the prices in California. Now, here is a condensed version of all our income limits throughout the state of California. Our program is available in all 58 counties in California. You just have to make sure all borrowers on the loan are within the income limit for the county in which the property they're purchasing is located. So if they're purchasing in Fresno County, the income limit for Fresno County is $174, $174,000. If their income is at or below that amount, they're within our income limits. If your client is looking to relocate to Sacramento County, Sacramento County's income limit is $225,000. And they're very moderate income levels. We do from time to time change our income limits. They can increase, they can decrease annually. So you want to make sure you're visiting our website. You're signed up for e-news alerts so that you know what the limits are when you have that client sitting in front of you, and you want to make sure you're within the program limits of our programs. But these income limits are specific to our My Home Assistance program and our Cal Plus Zip program. If you have any clients that luckily received a Dream for All voucher, keep in mind, Dream for All has its own income limit. So keep that in mind. I know I have brokers, I have some real estate agents on the call. You might get those individuals that receive the voucher, but Dream for All has its own income limits. But yes, now earlier in the class, I mentioned that on a conventional loan, we will go down to a 660 credit score for conventional borrowers if they're considered low income. And basically, how we determine if your client is low income is if they earn 80% or below the AMI, 80% AMI income limit. So basically, you want to go to Fannie Mae's area median income lookup tool and type in the property address of the property your client is purchasing. You will get to this page, and you want to focus in at the 80% AMI income limit. If your client is at or below, they're considered at or below the 80% limit. They're considered low income, and there's a few benefits that they will receive from CalHFA on this program. So they will get to have a lower credit score. They also will have a lower interest rate. They also will even benefit from having lower MI coverage. And I can tell you, as an example, if your client is purchasing a home on a conventional first mortgage, they're low income. The loan to value is at a 97% loan to value. The MI coverage for a low income borrower is about I believe it's 18%. Whereas if they're not low income, they would go up to that 35% MI coverage. And that can make a big difference in someone's mortgage payment because their monthly MI payment would be a lot higher versus someone that's low income. So always go out to this website to confirm whether or not your client is in fact low income. In this example here, I typed in our address in Sacramento, and for Sacramento area, the 80% AMI limit is $90,960. But please do not look at that at the 100% or the 50%. You exclusively want to focus in on 80% AMI when you're determining if your client is low income or not. But please look that up.